Can the U.S. Treasury step in to push down oil prices, or is that just noise? Here's why that rumor matters for your inflation view and rate expectations. Investor Scott Bessent says the Treasury is not intervening in crude markets and doesn't have the legal authority to do it. That resets the narrative at a time when investors are on edge about energy's role in headline inflation and corporate margins. Oil feeds into transport, manufacturing, and consumer prices, so policy speculation can move stocks, credit, and commodities. Clearing up who can act and who cannot strips out one source of uncertainty. Treasury's job is federal finance, debt management, sanctions, and financial stability. It does not manage physical oil supply or set commodity prices. The Commodity Futures Trading Commission oversees futures and derivatives under the Commodity Exchange Act. The Department of Energy runs the Strategic Petroleum Reserve, created to handle emergency supply disruptions. That's where levers like crude releases live, along with potential coordination from the White House. Not at Treasury. In practical terms, Treasury cannot order an SPR draw, tell refineries how much to run, or target oil futures prices. Its tools touch energy only at the margins, mostly through sanctions and financial regulations that might shift trade flows or market liquidity, but are not designed to fine-tune commodity prices. By underscoring the lack of statutory authority, Bessent narrows expectations to known, tested tools rather than new, untested steps. Why does this matter for markets right now? It reduces the tail risk of a surprise Treasury move shaping near-term energy prices. It pushes the focus back to supply and demand, inventories, OPEC plus behavior, and the inflation data that anchor rate paths. And it shows how communication itself can calm volatility that had been stirred by policy chatter. For investors, the takeaway is straightforward. Watch the Department of Energy and the White House for SPR signals. Track global supply developments and shipping flows. Recenter oil assumptions on fundamentals, then map that to headline CPI and earnings sensitivity. Positioning should reflect actual barrels and data, not hopes of a Treasury backstop that isn't coming. Want a deeper dive into the policy framework and market implications? Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.